Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as wealth advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky. And guys, here we are. It's after Thanksgiving. How was the Great Turkey Day for you guys?
Oh, my goodness. It was good. I did moderate my consumption. I feel pretty good about that. Steve got a little exercise, too, on that day. Not a lot, but a little bit. And so feeling pretty good here.
Was the exercise going back and forth to getting seconds and thirds? Or was that
Well, don't make
walk?
me have to specify now. We burned off some of the calories making the trip to the kitchen.
Yeah.
Well, digesting burns calories too.
Oh, yeah. That's right.
Yeah.
That's right.
Yeah.
No, it was great. It was a very, very wonderful time, great time of year. Came late this year, too, in November. So here we are, already just a few weeks away from Christmas. So we say it every year. It feels like it comes quicker and quicker and goes quicker and quicker. But
I guess that's a sign of us getting older and older.
Yeah. As we age, time moves quicker, right?
Oh, yeah. It feels like it.
Becomes a smaller and smaller percentage of our total lifetime.
Well, give it a few years, right? Aren't they saying people are going to live forever?
I've heard that.
Some people are saying that.
I don't know. That might be a curse.
It's quality of life, right? Quality of life. That's what we're looking for. So
we're looking for health span, not just lifespan.
That's right.
That's right. That's right.
Yeah.
Steve, a few weeks ago, we had the Angel Flight Central Gala, and it was something that I've been passionate about for many years as a pilot for Angel Flight. Basically, we fly humanitarian missions for folks in need, and mostly folks that are trying to get to their healthcare treatments that otherwise would not have been able to make serious healthcare appointments with specialists or folks that need transplants, or they need to get to a certain chemotherapy, or even children's hospitals, kind of you name it. And Angel Flight Central, we celebrated I say we because I'm also a board member. I'm the treasurer of Angel Flight as well. And Keen Wealth was the presenting sponsor of the gala again. I believe that was, Matt, was it the 6th or 7th year?
7th year, they mentioned. Yeah, 7th year.
Yeah, they were very kind to us there from the podium. And I've spoken from the podium there at that event a time or two, and I got off the hook there for that. But they definitely gave us some nice accolades there for our support. And no, it was great. I think there was about 900 people down at the Sheraton Crown Center here in Kansas City in support of the outing. And it's pretty amazing, Steve. The founder was there, and his objective 30 years ago, 30-year anniversary, was he had a plane and he thought, hey, if I could help somebody that needed to get to treatment, maybe I could do a flight and I could get a couple of my buddies to do a flight or two a month for people in need. And now we do 7 or 8 flights a day. A day. So thousands of flights a year, coordinated right here out of Kansas City, helping. We have about 350 volunteer pilots that are volunteering their aircraft and their fuel and their time to get, and we're matching those pilots with patients all across the Midwest that need help. The last one I did was getting someone back to Oklahoma from Mayo Clinic up in Rochester, Minnesota. And I believe we got that gentleman up and back 6 or 7 times over a short period of time. And honestly, just literally probably wouldn't have been able to get the treatment. So that was great. That was just a few weeks ago. Again, it happens this time of year, and thought I would share that with you. And, just something really, really cool to be able to do with our aircraft and our resources here, and very fulfilling. And it was cool to see everyone come together like that. Yeah, really nice.
Yeah, well, it is, and it's great that you do that and devote your time and talents and your plane to helping people like that. So a great act of kindness for sure.
Yeah, and you never know when what tomorrow brings for any of us, right? So Yes, a lot of times it has to do with finances where we're helping people get places. They don't have the financial resources, but in other cases, it's just people that aren't able to, you know, to fly commercially for any number of reasons. So we always say that we're all just one doctor's visit away from maybe needing the service ourselves. So I never take it for granted and just do the best we can for folks every day. So anyway, thanks for letting me share that with you.
All right. Well, great. Well, we got another good episode lined up here today. And since we are near the end of the year, we thought this would be a great time to talk about some smart financial moves to make here before December 31st. So, Matt,
as opposed to the other kind, right?
The unsmart?
Yes.
Or no action.
And those happen.
Yes.
Yeah.
Or no action, which is also not good too in some cases.
Now,
right.
it may not make sense to do anything, but at least review your year-end situation. And a lot of this has to deal with taxes too, because there's a big portion of the tax code and the strategies that they have to be implemented before 12/31. And we talk about this all the time with our tax planning. It's like most people don't get conscious or aren't thinking of taxes until tax filing time. Well, by that time, it's too late for almost everything.
Right.
I mean, there's a very small percentage of things you can do when you file your taxes that it just is what it is at that point.
Matt, so we were talking to folks, a lot about this. Like they come in and they see us and they say, hey, we think we need a new CPA, or we think we need a new a tax person, because they're not giving us any proactive. They are doing what we ask them to do, and that's report history.
I pay so much in taxes. What can I do?
Yeah, report the history to the government. Really is what they're doing come April. When you're filing your taxes, but they said we need a tax person that's going to be more proactive, and just to be clear, that would be a separate engagement,
and it's not their role. I mean, they're there to file your taxes. Like financial planners like ourselves are the ones who do the planning, the tax planning.
Yeah, you would have to hire a CPA well ahead of time in the prior year and say, I want you to do proactive, research-based. Look at my whole financial situation holistically and give me ideas. And most tax folks aren't doing that, don't have that service. Some may,
right?
But at Keen, we really, because we work on the investments. We want to make folks' dollars expand and grow, but what matters is what's left after taxes, and that matters as much. And so that's the proactive tax work that we're doing on our side here. And then we work with the CPAs to say, hey, this is what we're thinking. This is what we're going to do. So we are interfacing with the tax people for our clients, bringing proactive ideas to them, and really just trying to coordinate or quarterback that relationship so that the team is working for the client.
Right.
So, and that's all after all these years, 34 in the industry, that's how I've seen it work. I know a lot of financial firms do not do the level of tax planning that we do at our firm. It's pretty tedious, and a lot of it's very detailed. So a lot of firms just don't want to put the resources toward that, but we do, and we have the professionals on staff to do it, and we have the expertise here with Matt today to talk about it on our program as well.
Oh, sure, okay,
building them up there.
That's right. That's right. I'm the
Well, what else I wanted to tell
nerd.
We are at, this is crazy that I didn't mention it, because you would think that there would be fanfare around this. But today is our 250th episode. Guys.
Oh, man.
Oh, wow.
I mean, when we hit 50, we celebrated. When we hit 100, we celebrated. I think when we hit 200, we celebrated, and we almost forgot to mention this is episode 200.
Wow.
I should have had my app that had the sounds on to get some, blowing some horns and whistles or something here. Fireworks.
Right. Yeah.
But anyway, so there's been a long history. It made me think of that when you said I'm building Matt up, because really Matt's built himself up over 250 episodes in all these years in the industry. But nonetheless, that's cool.
Been a decade now, I think, that we've been doing this. Have we been going at this about 10 years now?
Yeah. Isn't that crazy?
We have. And every single episode is out there online through Spotify and through iTunes and the other channels where
Yeah.
folks can go back and listen to them if they want. Very educational. Go back and listen to what we were saying during times of market turbulence or things that were happening that were scary, even COVID maybe, or, I know nobody's probably sitting around saying, I want to go back and research through the Keen's old library of what they were saying.
Especially when it's old tax rules. Don't take any
Yeah.
action on old tax law.
Yes, that's a very good point. But it is interesting to see what we were saying and how we were guiding and counseling people through difficult times like COVID or other things that have come up. It'd be kind of interesting to see. You can kind of go, well, hey, what were these guys saying back then, and how did things work out? It can be informative. So anyway, thanks for letting me bring that up. It popped into my mind. So
yeah, well, and I think even though some of the stuff is certainly outdated because we may have been talking about certain tax changes, but there's a lot of evergreen content in those podcasts, which means this is information, material, ideas, insights that are going to last for years. That they're not specific to a particular time period. So
that's right.
Yeah, definitely would encourage folks to go back and peek through the list there and see if there might be any episodes that would be of interest to you.
That's right.
Good.
Yeah.
Heck yeah.
All right. So Matt, what would be the first thing that we should be thinking about here at the end of the year to get it done, or at least
speaking
review?
of new tax law, there was some changes that were passed mid-year, part of the One Big Beautiful Bill Act. And some of this does help people when it comes to year-end tax planning, and definitely some things to be aware of. One of the big ones for those that are over age 65. So there's a deduction for those that are over age 65 and are not itemizing. So that has existed. That's not new. And that is $2,000 if you're a single filer. If you're a married filer and you're each over 65, it's $1,600 per person. And that's not if you're not itemizing. If you're itemizing, it doesn't apply. So just a caveat there.
Okay.
Well, what the One Big Beautiful Bill Act did was they added an extra $6,000 per person over age 65. So that's in addition to the numbers I previously said. Now that is subject, and that doesn't whether you itemize or not. So that's, this is, it already is getting complicated.
Right. And Matt, that would be in addition to the others. So let's say you don't itemize, you still get the ones you mentioned first, plus this if you don't itemize.
Yeah. If you don't itemize, you get it. If you do itemize, you get it, as long as your income's not over a certain amount. So what that means is it's
do you happen to have that
phase out.
Do you happen to have that at your fingertips, what those phase out amounts are?
It's $75,000 for single filer, $150,000 if you're married.
Is that when the phase out starts, or is that when
it starts?
Okay.
And then it's like, I believe it's 30 cents for every dollar over, they start to phase it out till it's gone. So now, with all that being said, that additional deduction, could allow you to, take more of a withdrawal out and not, not increase your taxes again within these phase out ranges, or convert money to a Roth IRA, little things to be aware of when it comes to this additional, additional deduction, because that's meaningful. I mean, if you're married and you're both over 65, that's an extra $12,000 that just got tax free for everybody.
Or just pay less tax, right? Just keep it like it was and pay less. Okay.
That's right. Now on to the standard deduction. The other big change was the increase of what they call the SALT limit, which stands for state and local taxes. So part of the Tax Cuts and Jobs Act of 2017, they got rid of the personal exemptions. People remember that. You don't get an exemption for every person you claim as a dependent anymore. That's completely gone. They increased the standard deduction, and at the time, it was almost positioned as taxes are going to be so simple you can do them on a index card. Well, obviously
not quite.
Yeah, they're not that simple. However, what that increase in the standard deduction did was it basically eliminated itemized deductions for most filers. because what this standard deduction means is that unless you have other expenses such as mortgage interest, charitable giving, healthcare costs, over a
Mhm.
certain threshold, state and local taxes, if all those add up to be more than the standard, then you get a claim what they call the itemized deduction. Well, one of the big itemized deductions for people was state and local taxes. It was completely, there was no limit to it.
Oh, yeah.
2017, passing the Tax Cuts and Jobs Act, they limited it to $10,000. And that, that raised taxes for a lot of people because now you're limiting their itemized deduction.
And Matt, that's like state taxes, like state income taxes,
Yeah.
plus personal property tax, like on homes and things, right?
That's
So
right.
imagine living in New York or
High
California.
income, high state.
Or high state income tax. Or
Oregon,
where?
yeah.
Oregon,
Oregon.
yes, Steve. Yeah.
I
You
know.
got high
you
property
gotta
taxes
pay.
here.
Live in those nice areas, Steve.
So 10,000 wasn't much. Now 40 is better.
So now it's increased to 40.
Yeah.
So that's the new rule. So that's a plus for those that itemize, and especially that pay a lot in state and local taxes, because that's what that applies to specifically. And again, subject to phase out, but it's pretty high. It's $250,000 for single filer, $500,000 for a married filer.
Okay, so the uber wealthy didn't pick up much there.
And no, but still, if you're making several $100,000 a year, there could be definitely be a benefit there. And
sure,
it depends on how you think about itemized deductions. I think some people, they might know off the top of their head they don't pay much, but if you use tax software, typically they do ask you the questions to fill it out and compare the two, because I think it is worth people to just know and plug in the numbers, because you never know. It actually, you may pay more than you think, and that definitely helps you. Another change was related to charitable deductions. But the deductions, it's really more applies to high earners. Now, this is starting in 2026. So, they'll cap your deduction for high earners at like 35%, even if you're in the 37% bracket. So basically you're kind of losing a little bit of the tax benefit if you do give a lot to charity. I would say that's probably not meaningful, that extra 2% to most folks, and whether they're going to give or not give, but that is a little caveat. They did increase what they would, I would call it like the small gift limit. So in previous kind of tax rule changes, they've allowed people who don't itemize to take a small charitable deduction.
Okay.
So, if you were giving, I think the old threshold was like $300 for single and $600 for filer. So it's, it's not a significant dollar amount, but if you gave, some to charity, and again, you didn't do enough of that plus everything else to itemize, you'd still get a little bit of benefit. And they've now increased it to $1,000 for a single filer, $2,000 for a married filer.
Okay. So even if you're not itemizing and you make some modest charitable donations like this, which are nice, excellent, you can deduct those whether you itemize or not. When you were mentioning that 35 and 37%, I initially was thinking that you meant, there's limits to how much you can deduct based on your total income.
That's right.
So if you give cash, you can donate, you can deduct, I think it's 50% of your total income. So if you made $1 million in a year, you can't just give away $1 million and deduct the whole $1 million.
That's right.
There's upside limits to what you can deduct. And it's different based on, if you give cash, it's a little higher than it is if you gave appreciated securities.
Yeah.
This 35%, 37% thing you're talking about, does not have to do with that. It just simply means your deduction is the tax bracket you're getting, I guess, deductions against, even if you're in the 37%, would be capped at 35%.
That's right. Yeah. So the portion that would apply in that bracket would be limited,
Slightly, yes.
That's right. Yeah.
And then there's also a new floor as well, correct? That like a 0.5% floor means the first slice of what you're giving
That's
won't
right.
count.
Yeah.
It's just the first 0.5% doesn't count either. Look, they're really kind of picking away at the fringes here of the charitable deductions. Not enough to get anybody hot under the collar, but enough to probably generate a little bit more tax revenue, I suppose.
Well, and what it all boils down to is when they're putting these bills together, they gotta balance the budget. That's all part of the process. So they're just doing these tiny little tweaks, because if they do this and then they give a benefit here, well, where are they going to offset it somewhere else? And so that's where like these weird little things come into play. It's not like someone just said, I think it should just be 35%, and that's why they decided. It's more so just they got to make the numbers work.
Yeah, they got to sharpen their pencils these days on this
Well,
stuff.
I don't think their pencil's been sharpened for some time, because they still never balance the budget, even though they're supposed to.
Right.
It's like you do all these goofy little things, and it never, the budget's always over.
Oh, it is. Yes.
That's right. So those are some big ones, or at least some little nuances for 2025, and definitely the charity for 2026 for those that are high earners or high givers. But then you've got ones that essentially apply every year, kind of like Steve said. I mean, the concepts are the same, unless there's a significant change where you just can't do something anymore. But just looking at where you are, where do things stand? And like one of the year-end tax evaluations that we do is, and we actually do this throughout the entire year, but we look at what's called tax loss harvesting. So when you have investments in what I would say a non-retirement account, so this is just what sometimes is called as a brokerage account or a taxable account, and those investments have gains or losses, depending on what you paid for it and what it's currently valued at. And if you have losses, you can sell that holding, whatever it is, stock, bond, ETF, mutual fund, lock in the loss for tax purposes. And then you can take those proceeds, reinvest in something similar right away, or you can wait 31 days and reinvest in the exact same security. But you've locked in a loss for tax purposes. So that's definitely something to always evaluate, because if you've got gains that you have already realized, you can use those losses to offset it. Or if you can see maybe next year you have some gains, potentially from something else, you could at least maybe lock in some losses, and you get to carry those forward with you, which is a positive. But on the flip side, this is probably discussed less, is the concept of tax gain harvesting.
Okay.
So it's the opposite. You have gains in your portfolio, and you think, well, why would I trigger a gain? Well, if your income is no higher than the top of the 12% bracket, so they're really, really close. But if your income is less than the 12% bracket, which for 2025, I believe it's right around 100,000.
Okay.
Bill can probably look that up while I'm speaking about the rest here, and that's for a married filer. It'd be about half for a single filer.
The bracket, Matt, 12%
yeah,
bracket?
the top of the 12% bracket.
Okay.
Because if you're in that bracket and you have room, so you're not at the top of the bracket, you can realize long-term capital gains and pay zero tax up until you're at the top of that bracket.
96,950 for 2025. And then for, have we announced to 2026 is 100,800.
100,000, that's
for
right.
2026.
Okay. 26. Yeah. So if you're in in those brackets, one, I mean, there's a lot of things to look at. We already talked about the Roth conversion, in relation to that extra standard deduction. But you also, if you have gains in a taxable account, you could take those gains and not pay any tax. And then again, you can reinvest in something similar right away. You can wait 31 days, buy back the same security, and you've just reset your cost basis.
Yes.
So, Matt, let me ask you this. If your only income is Social Security, and let's say you have 35,000 of Social Security income, does that 35,000 count toward this 96,000 of the 12% tax bracket?
So it does. However,
But
I like that.
Got its own calculation.
Right.
So
Not all
Security isn't just taxed as ordinary income. It's a sliding scale. So if your only income is Social Security, it's pretty much in the example you provided, Steve, you would pay zero tax.
Okay.
As your income increases, then 50% of it counts as income, and then it's capped at 85% counting as income. So that's another nuance to all of this tax planning, is because you might think, hey, I'm not paying any tax on my Social Security, like using your example.
Yep.
And I have a gain. So I'm going to take this gain because I'm in that 12% bracket. I've got space. Well, by taking that gain, that gain might be taxed at zero, but what it might do is trigger your Social Security to count as income, which then now triggers the tax. So the two tax-free, you got to combine them, and then that might change what your overall tax liability looks like. So that's why, tax planning is sophisticated. You got to look at all these levers. Yeah.
So let me make sure I understand what you just said there. So let's make the math easy. Let's just say it's $100,000 is the top end of the 12% tax bracket. We know it's not exactly, but to make the math easy.
Close enough. Yep.
And let's say that you had 35,000 of Social Security income. That means there's 65,000 of room to get up to the 100,000. So if you start taking 65,000 of capital gains, that 35,000 of Social Security, probably 85% of that is now going to be taxed, right?
It could be, or count as income.
Or count as income. I'm sorry, count as income.
Which then now flows through the 10 and 12% bracket.
Right. And then the 65,000 of capital gains that you took, is all of that at zero?
That would still be at zero.
That would still be at zero. Okay.
Yeah.
But it just means more of your Social Security is going to be taxable income.
Yeah. Because even though what makes this confusing, it's like, well, capital gains is its own tax calculation too. We have this portion of it that's tax-free if you're in, certain income brackets. And then as your income increases, 15% of it is what the long-term capital gains rate is, or taxed at 15%. And then once it goes above, $500,000 or 600,000, it becomes 20%. But it from the tax code, even though it's a capital gains tax, they look at it as income for the Social Security calculation. So it's like even though it has its own separate tax calculation, they add it to the Social Security calculation for income purposes.
Okay. So one more question. I know this is getting technical. So let's say you took 75,000 capital gains plus your 35,000 of Social Security income. Now you've got 110,000, which is above the 100,000 for the top of the 12% bracket. That extra 10,000 of capital gains, is that going to be taxed at a rate, or does that make the full 75,000 now taxable?
Yeah, the good news is it's not a cliff. So it's not $1 over trigger. It's just that marginal portion is now subject to the 15% capital gains rate. Because now you've got 10,000 that's subject to that.
Okay. So in that case, it might make sense to actually it might make sense to go over that, pay a little bit of capital gains tax, because it's only at the 15% rate as opposed to the 20 or 22% capital gains rate. So
like one of the terms that we use sometimes is called effective tax rate. So that's where you take all of your taxes that you pay and divide it into your total income, not your taxable income, but your total. And that gives you your effective rate. And, there's even kind of a separate, you can look at it at each portion too. So you could say, well, what's my effective capital gains rate? Sure. Because if you're saying, well, yeah, I'm paying 15% on 10,000, but I had 75,000 of gains. Well, if I just divide it in there, it's like my effective capital gains rate is still very low.
A couple percent or something.
Yeah. Exactly.
Effective or average. I mean, average tax rate. Yeah.
That's
and
right.
remember, like you just said that, and effective is now indicating what I was getting ready. I was thinking of, and I was being quiet, listening to Steve try to stump you, which he was not able to.
Yeah.
But it was, remember, these taxes that Matt's speaking about are after deductions as well. So you do
That's
have
right.
that if your standard deduction, then you can start.
Add that on
whole
top of it.
slug of income that's tax free, or if you're itemizing even more. So yeah, really, really good to understand these things. So many people miss some of this, and they're solving for just the least amount of tax in any given year. Like, hey, we could just pay zero tax. We're in a zero bracket. Well, hey, there's things to do to maybe even still pay zero and accelerate some gains, or just a little bit, like you mentioned, Steve. So really, really got to be thoughtful about this.
So it's possible to have 100,000 of income and pay zero federal tax.
Mm-hmm.
Yeah, isn't that interesting to hear that?
Yeah.
To hear that
because if you took it all as capital gain,
right?
Yeah,
right.
And that's
I mean, that's something that wealthy people do is they try and shift the form of their income. So instead of the income being wages, which
earned
is
income,
earned income at ordinary tax rates, they try and shift it to like capital gains type income, or they borrow money off of and pledging, their existing assets for margin loans and that sort of thing. So yeah, there's different ways to think about that. And this is all legal. We're not saying anything that's like against the laws or anything. It's like, this is like smart tax planning. And again, that's like what you guys do. It's like, hey, we want to help you pay what you're legally required to pay, but not pay any more than that.
That's right. That's right. Yeah, the tax code, I mean, it really incentivizes people to own assets versus earning income. If you look at it, where you could pay the least amount of taxes. Not always the case for every single person, but if you have a choice, hey, figure out a way to invest in such a way that you can maximize your lifetime tax liability. Because that's the other thing, kind of what Bill is mentioning, is it's not just today's tax bill, it's the lifetime tax bill. Because the other thing that is looming for those that are 73 and older is required minimum distribution. So that's one of the other things. You got 1231. You've got until then to take it out if you haven't done so already. If this is the first year, you can delay the very first one until April 1st, but then you have next year's required minimum distribution as well. So you've got to, just be aware of that.
Take 2 and 1 in that case. Yeah.
That's right. So they do have they have reduced the penalty if you forget. It used to be as high as 50% of whatever it was supposed to be. That was the penalty. So that, IRS was like, don't forget to do this. It's now reduced to 25% of whatever it was supposed to be, unless you figure it out quickly. It is capped at 10%. And how they define quickly, I think the way I interpret that is, if you catch it yourself before the government says you forgot to do this, that's, I would say, you've caught it quickly. In that case. So that's a big one, that those RMDs. But related to that is if you are doing charitable giving, we talked about just you do that during the calendar year and you claim it on your taxes, and that can help with your itemized deductions. But there's another way of sending money to charity, and that's out of your IRA. It's called a qualified charitable distribution. Now, this applies to those that are age 70 and a half and older. And that's a key piece. You actually have to be past your 70.5, birthday.
Like during the year.
Yes.
Past the actual date, not just
the distribution
in the year,
cannot come out if you're 70 and a quarter.
Right.
Whereas the RMD is the year you turn 73. It doesn't matter if it's in December, you can take it out in January. They just care about that. So once you're 70 and a half, you can send money directly out of your IRA, to a charity. And that would that would count towards your RMD, assuming you're 73 or older too. So that's one of the benefits, but it has to be done before year end.
Mm-hmm.
And, one of the things that we help a lot of clients do this because they give money to charity, and, their normal sense of doing it was, well, you send me the RMD, I'm going to write a check to charity. And we were doing tax planning with some new clients recently, and they were telling us this is what they've had been doing, and we looked at it and said, well, wait a minute, you're not getting an itemized deduction because you don't have enough deductions, so you're not getting a tax benefit for that charitable contribution.
Right.
If you just, instead of you receiving it and then you writing a check, all you have to do, and we can send you a checkbook, you can write a check out of your IRA directly to the charity.
Then it
The
comes
charity
right
gets
off
the same amount of money.
top. Yeah.
The IRS just doesn't get their hands on it. But again, if you're going to write a check like that, it's got to be cashed. And, occasionally we've had some, I would, great charities, but don't always, aren't quick to getting to their mail. And sometimes, and we can see if the checks have been cashed. And so it's like, hey, there's a check here that looks like it's missing. It hasn't come through yet. Do you want to call that charity up and make sure they go get that check cashed?
Maybe they didn't need the money as bad as you thought if they're not.
I guess, or
the
they're, so much stuff is online now. Most people probably aren't mailing checks, and you can use the routing number and account number and set up, online stuff with these checkbooks. But just be careful. If you do have a checkbook on your IRA, you don't accidentally write a check to, purchase a car, because that's a taxable event.
Unless we've talked about it first and said do that, right? But
that's right. That's right. That's right.
Imagine the checklists and things.
Charities, then that's the thing. Yep.
That's right. Imagine the checklists and things that we go through. Like right now, we are doing this, Steve, just to look behind the curtain. Every week I see, because I'm included on these emails from the client service team to the financial planning team, the list of RMDs that still need to be satisfied for the year. And we're just obsessively monitoring those for all of our clients to make sure that they're satisfying their RMDs. Just one example of a proactive thing we're doing behind the scenes with respect to this very thing right here.
That's right. Yeah.
Yeah. You send that check and you think it's going to satisfy your RMD, and the charity doesn't cash it till after the first year. That could be an issue.
Yeah. Yeah. And if it's sizable, that's definitely, now it would, once they cash it, it would apply to the year they cash it in, but that may not help you.
We have a Thanksgiving rule we've started laying out to a lot of our clients, and that's just, hey, you have all your charitable checks written by Thanksgiving.
Yeah.
And it's a reasonably
mail it. It's
decent,
not postmarked, it's cashed.
Yeah. So that's kind of a good thing to shoot for on these.
Yeah. That's right.
Yep.
And then we also have, in the spirit of giving, the annual gifting to, really to anyone, but typically it's family members. If that's part of your plan or something that you'd like to do, the limit is 19,000, which that limit, it essentially what they do, because it doesn't change every single year. My understanding is they run a calculation and they adjust it for inflation, but they only actually apply the adjustment in $500 increments. So until it actually eclipses that, they're not going to change it. So I think next year they have announced it, and I think it's the same for next year. Yep. So it hasn't to all those folks that are receiving these, it's going to be the same next year. And that is the truth. Sometimes I think some of the folks that are writing the checks say, oh yeah, they don't change this. This is, they're still going off like $12,000.
We still have some clients writing 10,000s. I remember saying, hey, it's 19 now. They're like, oh no, that's fine. 10 is fine.
10 is plenty.
But we're giving money, down to the next generations or brothers, sisters, even parents. I mean, you can put money anywhere you want as a
it's basically a non-charity.
That's right.
Person. Yep.
And remember, you don't get a tax deduction for that, but the person receiving it does not get pay taxes on that 19,000, and it does not go against your lifetime gifting exclusion.
That's the big thing with this. Is you don't have to tell anybody.
Yeah.
If you were to write a check for $20,000 and gift it to let's say your child, now you have to file the gift tax return, which still doesn't make it taxable, but you've just have all this extra paperwork
for that 1,000.
So you have that. So that 1,000 would go against the 31 million now for a couple.
You just used 1,000 of it, of your lifetime exemption at that point. Yeah. And remember, both spouses too, if you're married, can give that 19,000 to any one person. So you could each give a 19. So you could be up to 38 per child, let's say.
Per child, or if they're married, you can give it to the both people. If they have you can really spread that out if you so choose. And at the end of the year, you could do it at the end of the year.
Or Steve, or podcast co-hosts.
That's right. Here is your gift. Yeah, and it's not taxable. I
like that even better.
Doesn't go against that capital gains. It doesn't push it up into a in a higher bracket or anything, Steve.
That's
Social
right.
Security, which you're not taking, but could if you wanted. Right now, you've shared with the group here and the listeners. But
yeah.
Well, good. All right. Well, Matt or Bill, any other things we need to be thinking about here for year end?
I was going to say you've done a great job covering these things, and I know we are at the end of the year here. So some of the things we've mentioned, you'd need to get hightailing on it if you haven't done these yet. If you're a listener, not a client of our firm, and you need to take a look at some of this. Another thing that we always think about, kind of a final thought, is this time of year when we're gathering with family and thinking about our loved ones and how things might pass when we're gone. I would say, at this point, maybe just start to get to consider and discern how you may, if you haven't already, discuss with your next generation, with your kids and possibly grandkids, depending on their ages and stages of life, how things might look if you were to unfortunately fall ill or eventually pass away. So thinking about how you would want things to be preserved, even your digital legacy, like the pictures and videos and things you have on your social media accounts today, but really how things might go. And I've just seen over 34 years in this business, when someone finally gets their estate plan in order and begins to share with their next generation, maybe not numbers, they're not sharing, we have X millions of dollars, maybe if you want at some point, but maybe not necessarily at first, but really sharing kind of, look, these are the people you want to call if something were to happen. This is my estate attorney. Here's my financial planners at Keen, let's say. We do this a lot and we work with a lot of the next generation of our clients. We hold a lot of events and we work with that next generation already on their investments. So they're comfortable with us. When that day does come, they're not feeling afraid, scared, or intimidated to have and not know who to turn to or where to go. That's just an important thing to maybe not worry about getting set in place in the next 2 or 3 weeks before you're in, but at least maybe consider and discern how you might want that to play out, perhaps next year as you do some of your longer term thinking and planning.
Excellent. All right, guys. Appreciate it. Matt, as always, another excellent analysis of some final year-end moves here to make. Appreciate that. And for each of you listening, please make sure that you like and share the podcast here, and you can subscribe to it if you haven't already by subscribing through your favorite podcast player. We're also on YouTube as well. So make sure that you check that out and subscribe to that so that you can be, and also hit the notification button to make sure that you get notified whenever there's a new episode. And you can learn more about Keen Wealth Advisors by going to keenwealthadvisors.com. And we will catch y'all on the next episode of Keen on Retirement.
All right. Thanks, Matt. Thanks, Steve. Happy holidays, everybody.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.